Hey there, future real estate moguls. Welcome back to the channel. If you're new here, don't forget to hit that subscribe button, because today we're diving into a strategy that could save you thousands of dollars in taxes. And who doesn't want to keep more of their hard-earned money, right? Now, I'm sure you've heard that investing in real estate can help build wealth. But did you know that it can also help you save tons of money on taxes? Yep, today we're talking about how investing in multifamily properties can make your tax bill shrink faster than a sweater in the dryer. Stick with me, because by the end of this video, you'll know exactly how to save big on taxes just by investing in multifamily units. And no, this isn't some loophole magic trick. It's all about the right strategy and knowing what to do. So grab your coffee, settle in, and let's get started. First things first, why should you care about multifamily units? I mean, we've all heard about single-family homes, right? They're great and all, but let's be honest. Multifamily properties are the real tax-saving gems. Why? Because when you buy a multifamily property, let's say a duplex, triplex, or apartment building, you're not just buying one property. You're buying multiple units that can generate rental income. And more income means more potential deductions. Plus, you get the power of economies of scale. More tenants equals more ways to save. On top of that, multifamily properties are often easier to finance than single-family homes. So you can start earning passive income faster. And most importantly, start saving on taxes sooner. Alright, let's get into the good stuff, the tax benefits. Because, let's face it, if you're not saving on taxes, are you really doing real estate right? So here's the scoop. Multifamily units offer some pretty sweet tax deductions that can really add up. Let's break it down. First up, depreciation. Sounds boring, I know, but trust me, this is one of the most powerful tax tools available to real estate investors. Basically, the IRS allows you to deduct a portion of the property's value each year over time, even though the property might be increasing in value. That's right. Even though your property's worth more, you're getting a tax break because the IRS assumes it's losing value. So imagine you own a 4-unit building worth $1 million. With depreciation, you could potentially deduct thousands of dollars each year from your rental income, reducing your taxable income and your tax bill. Sounds too good to be true? It's not. It's real, and it's legal. Next up, the mortgage interest deduction. If you have a loan on your multifamily property, you can deduct the interest you pay on that loan from your taxable income. So, if you're paying $30,000 in interest over the course of the year, that $30,000 can be deducted from your taxable income. Essentially, the IRS is rewarding you for borrowing money. Who knew the government was so generous, right? Another one, property management and maintenance costs. Let's say you hire someone to manage the property or do some repairs. Guess what? Those expenses are deductible too. From replacing a leaky roof to hiring a cleaner, these costs add up, and they can be used to offset your rental income. That cracked toilet? Deductible. That leaky faucet? Also deductible. You're basically getting paid to fix things. You gotta love it. Okay, now we're going to talk about one of the best-kept secrets of real estate investors, the cost segregation study. If you're serious about tax savings, you need to know about this strategy. A cost segregation study allows you to break down the property's components into different categories, which can be depreciated at different rates. Normally, a property's value is depreciated over 27.5 years for residential real estate. But with cost segregation, you can accelerate depreciation for things like furniture, appliances, and even landscaping. So instead of waiting 27.5 years to claim that depreciation, you can claim a huge portion of it right now. And that can result in some seriously hefty tax savings in your first few years of ownership. That's right. Big deductions early on can mean huge tax savings in the beginning, which can help you reinvest and grow your portfolio even faster. Some investors save tens of thousands of dollars on taxes just by doing a cost segregation study. Let's take it up a notch with the 1031 exchange, an absolute game changer in the world of real estate investing. This one allows you to defer capital gains tax when you sell a property and use the proceeds to buy another like-kind property. Basically, the IRS says, you made a ton of money selling your multifamily building, but you know what? We'll let you keep that profit for now, as long as you buy something else. And the best part? There's no limit to how many times you can do a 1031 exchange. So if you want to grow your portfolio and keep deferring taxes, you can keep rolling over profits into bigger and better properties. It's like playing Monopoly, but without the pesky tax penalties. Here's the kicker. If you hold on to your multifamily property for at least 1 year, any profit you make when you sell will be taxed as long-term capital gains, not ordinary income. And guess what? Long-term capital gains tax rates are much lower than regular income tax rates. Instead of paying 25%, 30%, or even 35% in taxes, you might only pay 15% or 20%, or even 0% if you qualify based on your income. Talk about a tax break, right? And here's a bonus tip. If you qualify as a real estate professional, you can deduct even more from your taxes. To qualify, you need to spend at least 750 hours per year materially participating in real estate activities. That means if you're really serious about real estate, you could potentially qualify to treat your rental income as active income, which gives you even more deductions. Just be careful though, this isn't a free-for-all. Make sure you meet the IRS requirements before you go claiming real estate professional status. But if you qualify, you're looking at some serious tax savings. So there you have it. How to save thousands in taxes by investing in multifamily units. From depreciation to cost segregation to the magic of the 1031 exchange, there are so many ways you can use real estate to reduce your tax bill and keep more of your money in your pocket. If you found this video helpful and you're ready to dive into the world of multifamily investing, make sure to hit that like button, subscribe to the channel, and share this video with a friend who's ready to start saving big on taxes. You never know, this might be the push they need to get started. Thanks for watching. And remember, real estate is a marathon, not a sprint. But with the right strategies, you'll be racing past your financial goals in no time. See you in the next video.